Hello and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. And we will be looking to the week ahead starting February the 10th. So just before we get going, I'm just going to ask you to read through the risk warning. I'll just pop myself on mute for the moment. Okay, excellent. Let's crack on. So starting with the economic calendar that we look through, this I filtered as always to the coming week and for the high impacting events. Now also just in addition to what's on the economic calendar, I think it's very important to point out that potentially, anything that Trump says or does, particularly with regards to trade, could overshadow what we do see on the economic calendar. But I mean, if we just think about sort of, what we've seen going on over the past week, it's been another very volatile week for risk assets. We've obviously had the announcement of trade tariffs at the start of last weekend on 25% on Canada and Mexico, which were then paused on Monday. We can see that's the candle there that's the relating to Monday. So we saw that big drop on the open, then the spike higher. We also saw 10% trade tariffs applied to China. The retaliation from China was actually very measured, suggesting that they're sort of, willing to be able to tolerate 10% trade tariffs, at least for now. And actually, as we've moved towards the end of the week, obviously the non-farm payroll report hasn't been released at the time of recording this, but there's definitely been a sort of fading fears over trade wars and sort of more of a focus back towards US economic data. And obviously we've been having earnings come in across the week as well. So yeah, I think we're seeing a recovery. We've seen a recovery from the low points of the week in the S&P 500 as it's sort of heading back towards that 61,000 level. Now, whether we get there or not may depend on what we've got going on, but other sort of key movers that we've seen this week, we also saw gold reach record highs. Definitely worth noting there, although interestingly that safe haven drive has also come as the US dollar has sort of seen again some big volatile moves. That's Monday's candle, as we saw it sort of spiked right up before coming back down, finding support above that sort of 107.35 level. But anyway, so that's any comments regarding trade, etc., could quickly shift attention back towards Trump's policies. But for now, attention is back on the economic calendar, and rightly so, because next week, especially in the US, we've got quite a few key points to be watching. We've got Federal Reserve Chair Jerome Powell testifies. That's on Tuesday, February the 11th. We've also got US inflation data on the Wednesday, and then US PPI inflation on Thursday, and then retail sales on Friday. So very US centric week. Powell testifies again. This is his biannual showing before Congress. So I mean, just as far as Powell is concerned, the market's going to be really watching out for what his comments are with regards to the position of the US economy and the position of US inflation. Obviously we will have then the non-farm payroll reports in as well, but so far the position looks towards that the US economy is holding up well. In fact, it's pretty strong. Potentially, there's more danger of overheating than there is of recession. And we're also seeing the labour market report in December showed 256,000 jobs added. So again, strength in the US labour market. And then we've got inflation data, which is also due to be released when on the second day that he's testifying, that will be released. Now that will be really interesting because obviously inflation in the US is showing a few signs of being a little bit sticky. It's still above target. The Fed left interest rates obviously on hold at 4.25 to 4.5% in January. And Federal Reserve Chair Powell signaled that, you know, the Fed was in no rush to cut rates until the data showed it was necessary. Now, with this in mind, with the so far solid US non-farm payroll from December, still don't know January, and you know, investors are going to be watching this inflation figure closely. It's still above target, and the Fed really wants to have more evidence of disinflation before cutting rates again. But it's also worth keeping in mind that trade tariffs and spending policies under Trump, there is some uncertainty with regards to the inflation outlook. So the market expects Fed rate cuts to come in June. December CPI was 0.4%, whilst core CPI was 0.2% month on month, suggesting that underlying prices remained under control. But there are expectations for this month that both will be at 0.3% in January, which is likely to support the view that the Fed will keep interest rates unchanged in the March meeting. Now, any sense of hotter than expected inflation data could see Powell turn a little bit more hawkish, which could give the US dollar a boost. I think it's also interesting when we talk about inflation as well to talk about gold and what's going on with gold. Obviously, we've seen gold rally over the past, across the past couple of weeks. You know, it's broken out of that rising channel. It's going sort of heading towards that 2,900 level. We're just seeing a little bit of consolidation here around the 2865, and that's as the RSI is very much in overbought territory. So interestingly, you know, we've seen gold rise on safe haven flows amid this sort of uncertainty surrounding trade tariffs, but also I think there's, you know, it's that hedge against inflation as well, which is continuing to increase demand for gold. So yeah, as I said, you know, RSI in overbought territory, so we could see a little bit of consolidation. If we have a look when it was in overbought before, sorry, there has been sort of a move lower. So, you know, just be cautious, I think, buying in at these levels with that RSI in overbought. As far as support is concerned, next level on the downside, you've obviously got the 2850 there, and then you've got this, which is the 2790, which was the high that we saw back in October. Other thing to keep in mind with US retail sales. So we've got headline retail sales in December, and they're expected to show a 0.4% increase. And the 0.4% increase is coming after a 0.8% gain in November and a 0.6% rise in October. So basically the data is showing us that consumer spending remains resilient. And, you know, that's helped by that sort of 100 basis points worth of rate cuts that we saw from the Fed at the end of 2024, as well as the solid jobs market. Solid data, if we get strong data, though, that could actually just fall into that good news is bad news scenario for stocks. It would undoubtedly raise, you know, if we get hot inflation, strong retail sales, and a slightly hawkish Powell, well, that does raise concerns that the equities could start to come under pressure, given that the market would rein in rate cut expectations from the Fed. I mean, you know, at the moment, the market's considering the Fed will cut rates 2 to 3 times this year, but, you know, that may even be quite difficult, especially if we see Trump bringing in slightly more, you know, aggressive trade tariff policies and spending cuts. And tax cuts, sorry, above and beyond what's already expected. So on the downside, as far as support is concerned, this level here, 6,000, it's the 50 SMA, it's a round number. And then below that, we've got the 59.15, but we can see these long lower wicks here suggest that there's actually little selling demand at those lower levels. If we do manage to hold above that 50 SMA, then obviously 6,100 and 6,130 to fresh all-time highs could be in mind. Just whilst we're on the US, let's just have a look at the NASDAQ. Similar sort of pattern that we've seen, long lower wicks. This is the DeepSeek sell-off. This was the trade tariff sell-off. Recovered from the 100 SMA there, back above the 50 SMA, which is encouraging. Whilst it stays above the 50 SMA and we've got the RSI above 50, then we could be looking for further gains towards that 22,000 and 22,100 to all-time highs. Obviously, we do have earnings as well. We've had a lot of earnings over the past weeks. Big tech is pretty much done. We had some mixed reactions to the results. Obviously, Alphabet saw a serious sell-off after their numbers. In a similar way that we saw sort of a steep sell-off after Microsoft. This week, numbers are going to be from sort of likes of Coca-Cola, Cisco, Shopify. So still some figures to be watching out, but I guess, you know, ahead of NVIDIA, which comes later down the line. So excellent. And then we've talked about retail sales. So let's just have a quick look at what all this means as well. Sorry for the USD JPY. This is having a really interesting moment. So we've seen the slight weakening of that dollar, but not really. This is still more, I think, a strengthening of the yen. Obviously, we've had that wage growth data this week, which was stronger than expected, and that sort of fueled expectations, along with comments from the Bank of Japan of another hike in interest rates from the Bank of Japan. So we've got this USD Japanese yen, which has fallen below the 200 SMA. It's broken below the broken out of its descending channel. It's also breaking below the 100 SMA, and that's bringing us to this level here, which is around the 150 level, 150.80. That's a 50% retracement from the 2024 high to the 2024 low. So yeah, you know, if we get a break below that level, then I'm going to be looking sort of obviously at the 150 as the next key support, ahead of sort of 148.70 levels. And then on the upside, buyers are going to need to get above the 200 SMA at 152.80 in order to extend gains above the 61.8% fib retracement at 153.40. So let's just have a look at what else we're going to be watching next week. So we also have Bank of England Governor Andrew Bailey, who's speaking. Now, this comes after the Bank of England cut interest rates by 25 basis points yesterday. Slightly more dovish vote than expected. But interestingly as well, I think the comments from Andrew Bailey and the forecasts from the central bank were a little bit sort of concerning regarding the outlook for the UK, very much pointing to stagflation. So the markets will be looking to see if he's got anything to add from the comments yesterday. It's basically the central bank slashed the growth forecast for the UK to 0.75%. whilst also lifting the inflation forecast to 3.8%. That's up from 2.7% just projected in November. But the outlook is very much at stagflation. Interestingly, the Bank of England cut rates anyway, so that does suggest us that they see inflation trending lower after the peak higher this year. Any further warnings regarding the outlook for the UK economy could pull the pound lower. The market's currently pricing in around 3 more rate cuts from the central bank this year. So as far as what we're seeing in the chart here on cable, we've seen that recovery from the 121 low, but look, it's failed really to retake the 50 SMA. Now buyers are going to need to get a close above that level if they're wanting to extend gains towards that 125.75 level and on towards then the 200 SMA. But failure to rise above that means the outlook is looking a little bit more bearish. On the downside, watch this level here. This is the 123.65. That's recent spike lowers. It's also this falling trend line that dates back to 2007. So if we get a break below that, then look out for the 2300, which is the April 2024 low. Sticking with the UK, we also have, I do believe we've got UK GDP data, which, let's just double check there. It might not be on here, but I think we do. Yeah, there we go. GDP data for Q4. Now, interestingly, the Q4 we're expected to see very weak growth, if not a contraction, in the final quarter of the year. In fact, the Bank of England suggested that there could be a contraction as we see weak growth. Basically, we've seen a lot of loss in business confidence, in consumer confidence since the budget, amid concerns from companies over the outlook of increased tax burden when the national insurance tax increase comes into play in April. So this the data will be very much in focus given the slashing of the growth outlook by the Bank of England Governor Andrew Bailey. Now, all this weakness that we're seeing in the pound and sort of optimism surrounding interest rate cuts has actually helped the FTSE reach record highs. Look, this is yesterday. We saw it when it rose to a record level of 87.70, just below there, following the Bank of England interest rate decision. Obviously, there is quite a big upper wick on that candle, so there was suggestion that there wasn't that much buying demand at that upper levels, but we're sort of seeing it settle here around the 8700 level. But as I said, boosted by the weaker US dollar, the weaker pound. The pound US dollar is a more favorable exchange rate when the pound is cheaper, and that helps benefit the multinationals, which make up around 80% of the FTSE. The remainder of the FTSE are supported by expectations of, as I said, rate cuts from the Bank of England. So that's helped the FTSE break out after really staying relatively trade relatively range bound in recent months, over the past 9 months or so, but just levels to be watching out for. I mean, it is looking a little bit, not quite overstretched, but there might be a little bit of bearish divergence in the RSI there. So might see some consolidation around this 8700 level. As I said, that sort of long upper wick as well is just something to be mindful of. But on the upside, eventually higher highs would be a rise above the 8770 level towards the 8800. On the downside, if we get a break below here, then the next level on the downside to be watching out for will be around here, which is around the just around the 8600 level, before the 8490, which was the previous all-time high that we saw. So that's it. Also, we have banks, UK banks, kicking off their earnings season next week, particularly Barclays and NatWest. Barclays will be interesting to watch because obviously that has quite a strong investment banking arm, and given the upbeat results from US rivals, that could mean that we're in for some encouraging numbers from Barclays. Also expected that they could announce a £1 billion share buyback thanks to its strong capital position. NatWest reports as the share price has actually doubled over the past years, up around 8% in 2025 alone. That's thanks to the broader positive mood for UK stocks, and also on optimism regarding the outlook. Signs of sticky inflation in the UK could keep the NII NII figure supported, and margins well supported. So that's the difference. By the NII is the difference between what a bank receives in interest and what it pays out in interest for borrowing or for lending. So that's that. What else we are looking at next week? Okay, so we've got the Eurozone, we've got GDP data as well. Okay, so as far as the Eurozone is concerned. Basically, I think the data that we're expecting to see from GDP figures in the Eurozone, it's not the preliminary reading, so it doesn't tend to be as market moving, but we are expecting it basically to confirm that economic growth stalled in the last quarter of the year. And whilst the economy sort of did return to growth across the start of 2024, that it very much ended the year in stagnation mode. Growth was negative, particularly in Germany and France. Now, consumers basically, I think, are still suffering from the really inflationary pressures that were there across last year. And although sort of purchasing power is increasing, it's not yet translating through to stronger consumption. So yeah, I mean, investments also remained under pressure due to economic uncertainty and the sort of still relatively high interest rates. So weak growth is clearly a concern for the ECB, who cut rates back to 2.75% in January. Further weakness in growth could support further expectations of more ECB rate cuts, even as inflation sticks a little bit above the 2% levels. There is also concerns over stagflation in the Eurozone as well. This is the Euro-US dollar, very much in a neutral position at the moment. RSI pretty much neutral as well. Long lower wick on Monday's sell-off, because obviously Europe is also in line for trade tariffs, as President Trump did warn. Although those concerns have just eased off, as we've seen sort of, these trade war fears ease. Again, as far as sort of the upside is concerned, like sterling, it hasn't managed to push above the 50 SMA, which it is needed if we're going to look towards, the 104.50 level and the 105 on the upside. On the downside, if we get a break below the 103.40, that's the November low, then that's going to spark a deeper sell-off. But again, we've got those long lower wicks, so it does suggest that sort of demand at those lower levels, selling demand at those lower levels, is a little bit weak. Just whilst we're talking about Europe, it's always worth having a look at what the DAX is doing, because despite dismal data from Germany, the DAX continues to power to fresh all-time highs. I mean, there's just no stopping the DAX right now. Actually, the DAX benefits from a lot of international demand. And I mean, whilst there was a little bit of a put reaction to those trade tariff worries, not so much. I mean, the market quickly recovered higher, very much in overbought territory. So, very much caution to buyers here. There is, it feels like there could be a period of consolidation or a move lower before there are any further gains. If we just look to previous examples of where there's been overbought territory. This is here, we've seen a pullback to bring the price back up out of overbought, something to just keep an eye on. I mean, immediate support 21,800. This is sort of like the 21,700, the high that we saw in January. Below that, we've got the sort of 21,500 to be watching out for, and then the 21,000. That's the sell-offs that we saw from DeepSeek and from the trade tariffs concerns. But again, long lower wicks, so that tends to be a little bit more supportive of the upside. Let's have a look what else we got to get through. Pretty much done everything. There's also the China inflation data. So again, this is going to be released over the weekend. We'll see the reaction to this on Monday. Now, Chinese inflation data, it's due on Sunday at 1:30 in the morning, expected to show that CPI increased slightly to 0.4. That's basically after it barely moved year on year in December. Very much sort of concerns about deflationary pressures PPI will also be released and is expected to fall 2.1% after falling 2.3% year on year in December. So that will show that factory deflation extended into a 28th month. Now, concerns about inflation in China are very much sort of a concern. But if we do get that increase to 0.4%, obviously this comes following the stimulus measures at the end of the last year. That will be encouraging for the markets. Let's just take a quick look here. I mean, because obviously there's concerns over persistent deflationary pressures in China. I think it's also worth noting that that's the stark contrast to the sort of worries about inflationary pressures that we're seeing elsewhere across the globe. Now, this is the Hang Seng having a pretty encouraging week. We've seen a strong rise to out of 4, rising here to its highest level since December, and this is basically on optimism surrounding the tech outlook after the AI DeepSeek's AI revelation the other week. So, you know, if we get strong, an encouraging sign of reflation, then we could be looking to potentially get a move above this 21,400, which would then obviously bring 22,000 into the picture. On the downside, support here around the 20,250 level, and then you've obviously got the 20,000 psychological level to keep in mind as well. Just when we're talking about China, I always like to keep an eye on what's going on with the Aussie. It's not too dissimilar. I mean, with we're seeing this sort of like consolidation pattern with the Aussie. It has recovered from the low that we saw of 60.90, just below 61 on the trade tariff sort of worries. Long lower wick recovered above that, just testing the 50 SMA. So I think next week's going to be really key to see whether we can get a move above the 50 SMA on a lot of these charts, because if we do move above that, if we get some US dollar weakness because of, you know, cooler inflation or a sort of calmer POW, then maybe we could see these currencies break above those 50 SMAs. If not, if it's the reverse and we get that slightly stronger data and a more hawkish POW, then we could see a rejection again at the 50 SMA across the board. So, and just finally, just worth having a look at what's going on in oil, because oil has broken below this sort of this key support resistance level that we've been watching for most of the past 9 months, in fact, and we're back into that familiar zone. Post rejection up here at the 80 level, been falling down basically since Trump came to power on concerns over what his policies will mean for oil prices. We've seen that he's, you know, planning to increase production. He's also asked Saudi to lower prices, although that's not really going to take much effect. But OPEC meeting did suggest that they're going to continue with increasing output as planned as from the April-ish period. So that's obviously having a downward pressure on oil prices, which are now below the 100 SMA, below that 71.50, 72.50 support. That's now acting as the resistance. On the downside, looking down for 70 as the next level before we bring 67, 66.50 support zone into play. So that is everything from me. There was a lot to get through this week, and thank you very much for coming, and I look forward to speaking to you again next week.